Hello, everyone. I am Kim Hughes, and this is the January 4th edition of Sane Crypto Live. If you're watching this after the fact on the replay, appreciate you being here very, very much. Today's topic is 3 mistakes that will bite cryptocurrency investors in the butt, sure as I am sitting here talking to you today. So before I go through those, I like to ask what I call the question of the day. So today's question is, where are you from? And is your interest in cryptocurrencies as an investor, 2, in the technology and or social implications of that technology, or 3, all of the above, both, okay? All right. If you would put that in the comments below, I will circle back and check those out along with any questions that you might have about this topic or any others related to crypto. I'd be more than happy to answer those as well. Okay. So on to the topic at hand, which is these 3 mistakes that I see repeated over and over and over again. And quite frankly, these at least 2 of the 3 are common in all investors, whether it's cryptocurrency or not. One is specific to crypto, but let me tell you what they are, and then we'll go through them one at a time. So the first mistake is trading. Second mistake, HODLing. And the third mistake is never having tested your escape hatch. So I'll explain all of those here, especially the third one coming up. So let's just start with number 1. Okay, trading. There are any time that you have a load of new investors coming into the market, you see them thinking that they can trade their way to profits. And the saddest part about that is, even though professional investors know that without amazing algorithmic firepower, you can't do this profitably, the press knows it too, but they are more than happy to feed the novice investors, which makes me really sad. But trading violates, so we have Sane Crypto, we operate on certain 5 principles, first principles of investing. Trading violates 2 of them. One first principle that it violates is that no one can predict the future direction of price because they are random. And the other one is the swine paradox, which is that pigs get fat and hogs get slaughtered. What that means is, so in the world of investing, returns are described mathematically in terms of beta, which is the return that the expected return of any given market. And it will just over time, if you're just patient and don't do anything stupid like pay ridiculous fees or trade in and out, it will give you that beta naturally. Alpha is the return over and above beta. And that is what, when you hear someone say that they're trying to beat the market, they are going after alpha, okay? And alpha can be negative or positive. And the problem with alpha is that in order to get it, you have to take on excess risk. And most of the time you do that and you still don't get it, okay? So pigs get fat, hogs get slaughtered is just a memorable way of saying, if you just take beta, if you take what the market will give you, then you can make a really nice living from it. If you go aggressively after alpha, more than what the market will give you, the market has this amazing magical mechanism of slapping you down for being so, 1, greedy, and 2, arrogant. Okay, so those are the first principles. Now, this trading manifests itself in a couple of ways. Either day trading, even swing trading is still trading, and so it's either a belief in the ability to pick the ICO, the coin, the token that is going to outperform all the other ones. Okay, so that's the equivalent of stock picking, or the belief in technical analysis. So, which is to be able to catch these price moves. So let's just kill both of these real quick. So in terms of the ability to pick and outperform the market, let me just go to share my screen with you here. So this phenomenon, as I said, is not unique to cryptocurrencies. It happens everywhere. And our brain just wants to believe that we can actively trade and do better, but we can't. So today, or the other day, I saw this particular example of it. So it's timely. In 2007, Warren Buffett challenged or bet any hedge fund manager that he could pick any 5 hedge funds, including his own, a basket of 5, and that over 10 years it would not just beat holding the S&P 500. And so someone did in fact take him up on it. You can see the results were actually much worse than this. This is just the average hedge fund, the results of the 5 that were picked by the guy that took the bet. And it was, by the way, a $2 million, this is 1 million. I've seen 2 million in some places and 1 million. But nonetheless, so just holding an index fund that for the 10 years outperforms what are supposedly the best investors in the world, who charge massive amounts of fees to their clients for the privilege of investing their money for them. And you can see here the average mutual fund, if you just held the index, would be worth 225,000, 147,000 for over the 10-year period for the average mutual fund. And you can see here, in fact, that it was even worse. What was the difference here? Yeah, the hedge funds had only earned 220,000 while holding the index 854,000. Okay, so these are this is the thing that's crazy, because whether it's a mutual fund or hedge fund, there is just this unquenchable need, right? It's greed is what it is, right? That makes us think that we can do better, and that an expert can do better, and that trading in and out is going to do better. And in spite of all of the evidence to the contrary, Wall Street is built on this. Wall Street gets paid for doing something that everybody knows is impossible. And yet people still pay them to do it. It's amazing. And by the way, here, I don't want to get too far off topic. It just astounds me, right? They aren't even talking, there's no mention here of risk-adjusted return, which is how you really compare 2 portfolios. For every unit of risk you take, how much return do you get? Because if I take a whole bunch of risk, especially as a money manager, right, in order to get that return versus a portfolio that gets the same return without taking that risk, and therefore doesn't put my clients at as much risk, right? Well, those 2 things are not apples to apples. And I guarantee you, on a risk-adjusted basis, that the hedge fund results would have been even worse. Okay. Now, so that's one example. Here's this makes sort of a different point, but I still think it's germane to the crypto investor. This is the Callan periodic table of investment returns. It's been done for, 20 years or so. And what this really does is it makes a case for diversification. What it says is that not only can you not pick which stock or which coin is going to outperform, you can't even pick which sector, because each one of these colors is a different sector. Again, this is in the equity, the stock and bond market. However, each one of them is a different asset class. So, like, go here over on the left, this is the S&P 500 growth, S&P 500, Russell 2000 value, Bloomberg high yield, aggregate. This is foreign. This is emerging markets, and you'll notice that I mean, we had a little run here. So, and they're stack ranked, okay, from best performing to worst. And so notice, of course, that these, the colors change consistently, and they're basically a random pattern that nobody can, and that one that might be at the bottom, like, let's go over here. Where's my cursor? Down here, the Russell 2000 value was at the lowest, minus 1.49% in 1999. And then in 2000 and 2001, it was the highest returning asset class at 22, and then minus 11, right? Then 46, then 20. So the point being, you can't know. You can't know. And so what this argues for is diversification. Now, in the crypto world, in the absence of an index for us to hold, or a basket of indexes, as we would do here in the stock and bond world, okay, I would argue that Bitcoin itself is the next best thing, for many reasons, not least of which is the liquidity that it has relative to, it's not a lot relative to the stock and bond market, but it's a lot relative to all of the other coins, which will become relevant when we get to mistake number 3. Okay. All right. So that's trying to pick. Now, there's this other idea, which is technical analysis. And this just freaking kills me, because you don't see it nearly as often in the mainstream in the stock and bond world, because it's just pretty much been debunked, except for a few conspiracy theorists who hold on to it. But it's this idea of technical analysis. But I've noticed that here in the cryptocurrency market, it's everywhere, I guess, because these guys have to fill space in their publications and their newsletters. And this is the easy, and if you're not commenting on, the market, then, and technical analysis, then, you don't have as much space to fill. But so basically, anytime you see something like this, right? Bitcoin Cash is up, but correction may be on the cards. And then, this is your key phrase here. Despite decent gains today, Bitcoin Cash prices could take a hit in the short term, the technical charts suggest. The tarot cards suggest. That's what they're saying. Okay, this idea, anytime you see a chart and you see people drawing lines on it and saying that, oh, here's, it's the start of it broke out of this moving average, or, that there's this pattern in the chart, a cup and handle, or a pennant, or you guys, it's bullshit. It doesn't, it is absolutely, here's the analogy, okay? Technical analysis is to investing as astrology is to science. It is pattern matching in looking backward. There are over 1,000 different technical indicators that these people, and by the way, I started out, I know it doesn't work, right? Because I myself decided to test it when I first started out as a trader way back in the day. And it's, you quickly learn, if you're honest and you keep meticulous data and records, and you don't retrofit and data mine and do all these other things, that it works just often enough to make you think it works, but not often enough that you actually make any money from it. And I don't know anyone who's made money on it. And it's debunked. There are over 1,000 of these different indicators, and that is because no one of them works often enough to actually make you money. If it did, everybody would be making money on it. So it's like astrology. It's like when the ancients looked up in the sky and said, oh, look at those 8 stars. They make a crab. And these over here, they make something else. They're pattern fitting. But it doesn't mean anything, nor can you predict anything off of it. And so when you see these, if you're using them, run away. If you see these, ignore them. If somebody is suggesting you take an action based on them, right? Even something as seemingly innocent as saying, well, there seems to be resistance at 16,000. Okay, fine. But That's not the basis. What's going to happen after that resistance, either up or down, nobody knows. Okay, so if they say they do, they don't. Okay, no one can predict the future direction of price consistently. No one can trade and make alpha on a consistent basis, on a risk adjusted basis, without massive supercomputing algorithms. So don't do it. Okay. Okay. So that's mistake number one, trading. It's a fool's errand. Here's mistake number two, HODLing. Okay. For those of you not familiar with the word HODL, it is an acronym, HODL, often with the hashtag, has been now pronounced as HODLing. It initially meant hold on for dear life. It now is the battle cry for, I think, the young people who haven't been around long enough to remember what the internet bubble felt like. It also tends to be the people who are really close to the technology, the original developers, community, who and to date, because what it means now, right? The battle cry is never sell, no matter what, right? You're a fool if you sell. Well, to date, that has been true, however, again, first principles of investing, are this time is never different. This time is never different. So if people say, oh, right, this isn't going to do like the internet did, this time is never different. In fact, history just repeats itself over and over and over again. And as an investor, it's your job to pick that out and use that to your advantage. HODLing completely flies in the face of that and assumes a couple things. One, that this time is different, which defies first principles. Two, it assumes that you can pick the winners over the long run. And I hear this all the time, by the way. I hear people say, even if it is like the internet bubble and we do have a crash, if I HODL through it, then I'll be okay. In fact, people who held through the internet bubble are really happy campers right now. And that's revisionist history. It is in fact wrong. Here is a poster child for the internet. Okay. Bubble, I remember, because I was trading it back in the day, okay? And so Cisco, and this is a great example, and I'll tell you why, because Cisco was the infrastructure of this internet thingy back in the day that they were building. The companies that were built on top of that infrastructure, right, and came later, some of those, yes, went up and made money, but at the time, right, an infrastructure play, which is what most of what we're seeing today in the cryptocurrency space was. I'm not saying that that's why they're going down, but what I'm saying is this is a perfect example. This was a darling of the internet bubble, and forget the thousands that went by the wayside or were acquired because for pennies on the dollar, the AOLs, and that were huge back in the day, right? And the price would shoot up hundreds of dollars a day. The NASDAQ would go up hundreds of dollars a day, and people were making money hand over fist, and they thought it was magic internet money, just like people say now. And then this is what happens. If you had bought Cisco, okay, anywhere over about here, you would have never gotten your money out of it. You still, 15 years, 17 years later, have not seen these highs in Cisco. Okay, so this idea, and by the way, even if you held the NASDAQ itself, the index fund, the QQQs, it took you 15 years of dead money to get even back to break even. No investor is happy and is going to sit there and hold through 15 years of dead money, because not only did they just get to break even, but there was an immense opportunity cost. That was a huge bull run during that period of time. So you cannot look at it and say, oh, well, I'm going to HODL because, to do otherwise is ignorant, which I hear all the time. The time will come, okay, when something like this is going to happen, okay? So now the question becomes, and by the way, let's just hope. So here's our roadmap. This is the Sane Crypto roadmap, and you can see in my worldview, based on the fact that this time is never different, this is an investable bubble. Okay, that's what I call this. It is characterized by irrational exuberance, people with no experience piling in, thinking that they're geniuses with clouded judgment. The predominant emotion is greed, and the way that we succeed in that sort of a market is we protect our profits with a rigid trading plan that we follow. As if our life depended on it. Now, but the point being here, if you look at this, these market cycles here, this bubble, we're in the bubble phase, okay? And this is what happens. You have the bubble, then you have ashes when the bubble crashes, and out of that crawl some caterpillars. Most will die. Most of these, 98% of these coins will not survive the crash, okay? They will not survive. Many of them will not survive crash or no, but nonetheless, but out of those will crawl the 1 or 2 or 3, whatever, Amazons. Okay. Those will be the caterpillars and they will turn into the butterflies. And at this point, blockchain will be as ubiquitous as the internet is today. And these will just be normal companies that we won't even think of anymore as being internet companies. They're just the companies, right? But for us to be able to think that we can pick which, and hold, which of the caterpillars are going to survive that crash through those ashes, history tells us, one, that's impossible. I can't even think of anything more arrogant. So the only reason you would hodl is if you didn't believe this bubble that there was ever going to be normalization of prices, and that just flies in the face of everything that we need, that we know. So the question then becomes, okay, well, fine. If you can't hodl and you can't trade, then what else is there? What do you do? Okay, and I argue that this is a very unique case that we're in right now. The fact that it is still early on, I hope, it's an investable bubble that I hope will last a really long time. Could be tomorrow, could be 3, 4, 5 years. Who knows when it's going to burst? Nobody does. I certainly don't. And so the gamble that we are making is that we can make enough money from it if we are very rational and sane and calculating, and protect ourselves when on the way down, which is easier said than done, by the way. But so the way that so the answer to that, by the way, is it's a hybrid approach. Okay, it's not trading, it's not hodling, it's somewhere in the middle where we hope for the best but plan for the worst. And if you want to learn more about that, here's the sanecrypto.com/webinar. You can check that out on next Wednesday. But anyway, so that's number 2. Now here is number 3. Mistake number 3 is never testing the escape hatch. Now, what do I mean by that? So I was having a conversation with a friend who is invested in cryptocurrency, has made a lot of money. All of a sudden, right, they're starting to think about, well, what happens when I need to take all this money out? And I would argue, and in fact, it's kind of here in our system, that you have to at least test the escape hatch fairly regularly, because what happens is one of the we have our brain. We operate day to day on something called heuristics. They are shortcuts that we create in order to make decisions, because otherwise decision making would just be hugely difficult given the millions of pieces of incoming information that we have to process every day, right? So these shortcuts help us deal with the world, and behavioral economists have identified all of these what they call emotional biases that we use as heuristics. One of those biases is called representative bias. Representative bias says we assume that what has happened in the very recent past will continue in the immediate future. And what that does is it makes, so the fact that these, the crypto market has been going up, 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 right? Representative bias causes us to get sloppy and lazy and not think about and plan for what happens when it goes down. So I'll tell you a story briefly. I cut my teeth back in, I learned how to drive during the blizzard of 79 in Chicago. I also cut my teeth as an options trader right at the start of the internet bubble. It's why I feel so passionate about this. I remember all of this viscerally. And at the time, it was 99. So if you can kind of look at this Cisco chart and have a sense of where we were at in the cycle. It was May of 99. I was an options trader. I traded options on the S&P 500. I was an off-floor trader. We had a squawk box that allowed us to, because again, this was, the internet was still barely a thing, right? So, but we had a squawk box that allowed us to hear the pit, the S&P pit, and where the guys are all yelling at each other. And back then it was all guys. And the reason that we did that is that was like, for us, that was the best we had in terms of sentiment analysis, because you could kind of hear the pitch, the tone of them yelling back and forth, and that kind of gave you a sense of what was going on. So one day in May, it was a very typical sort of period of time like here, where every day the market would go up 500, 600 points, sometimes 1,000 points. I mean, it was crazy stuff. Because for me, right, as at that point, 30 years old or something, 20 in my 20s, that it seemed like I had never seen anything like this before. Clearly, right? Each generation forgets. Our first bubble is pretty magnificent, and every day it would go up. And sure enough, everyone's just like kind of lounging. You didn't have to work very hard to make money. All you had to do is bet on it going up, just like today, cryptocurrencies. And then all of a sudden, out of absolutely nowhere, all hell breaks loose. I mean, like you've never seen anything before like this. What happens is it's announced that Robert Rubin, who was at the time Clinton's Treasury Secretary, and everybody thought, the architect of this amazing economy, announces out of the blue with no warning in the middle of the trading day, which is usually not done, that he's resigning, right? And so all of a sudden everybody's buying, and then all of a sudden you could hear, like I wasn't there, but I can just imagine what was happening. Like all of a sudden it started to get like almost so quiet, like it just that the normal rumble of all the activity just came to a stop, and you could almost hear a pin drop, and then someone says, they all kind of look at each other, and someone says, sell. And it's this cacophony, this I mean, I can't even tell you how hard this market went down, because everybody at the same time is trying to get out. They're fearful. It's like when you see a saber-toothed tiger, do you stop to think about the consequences of the saber-toothed tiger? Does he have teeth? Does he? No, you run like hell. And that's what happened. The market went from like up, I don't even remember. It was up huge to down huge. I mean, it like lost 1,500 points in a matter of minutes. And sell. It's crazy. People didn't care what price, sell, right? And then the opposite happens. So finally, everybody's sitting there, right? I can imagine them like, they're probably like all these guys sitting around, because most of them like smoke and drink, and like they're not in good shape. They probably are having heart failure. And so then when it finally sort of starts to recede, and you can kind of hear the silence start to come back again, and there's like this long second, and I can imagine somebody sort of stopping and thinking, hang on a second. I mean, it's not like Alan Greenspan resigned. If you remember, like, Alan Greenspan was a god back then, right? And and then the next thing you know is like, bye, 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 bye. Market closed up that day. Huge, huge. Okay. Never before, never since have I, nor any of the people that I knew who had been in the markets for a really long, long time, had we ever seen a whipsaw like that in a day. But it taught me a really valuable lesson. Okay. It was in fact a foreshadowing of what was to come once the bubble did burst. Okay. And, one, I learned how fast because you think, the worst won't happen. I won't buy insurance because my house won't really burn down, right? And as soon as you don't have it, boom, your house burns down, right? Karma is a bitch that way. And I realized just how fast someone could go broke really fast, and how when everybody's heading for the exit at the same time, how fast that price could move. And this is a multi-trillion-dollar market we were talking about here, where it's there are hedge funds who manage more than the total market cap of the crypto market. Okay, so like when let me just tell you that when that happens for real in the crypto market, and everybody, it's not just a psych, a fake, a head fake, it's for real. Everyone heads for the exits at the same time. It is going to be bloody. It is going to be bloody. Okay. And it is all well and good to say that you're okay with losing everything. I'm just putting in risk capital. I'm okay to lose everything. Okay. But will you really be the one, playing violin on the deck of the ship as it's going down? Or will you be trying to get a seat in the lifeboat? Well, I think whether you think you're going to HODL right now or not, when you start to see that blood in the streets, you start looking for a lifeboat. Well, have you tested the lifeboats? Do you have any idea how to get your money out of this thing? Have you considered things like that you might not be able to transfer if you've got all your money in a wallet, which is best practices, right? Hardware wallet, preferably, on your person, maybe even in a safe deposit box, which is, again, best practices, right? Have you considered that even if you have it on you, that the brokerage firms and exchanges are going to be so overloaded that you wouldn't even be able to send your Bitcoin or whatever it is to them to liquidate it, because the system is so overloaded. I mean, think about what happened when Coinbase added Bcash, right? I mean, that was just a little thing, one exchange, but imagine where they had to shut it down, and now they're not going to offer, they had to walk that back and say, oh, you know what, we'll plan for this a little bit better and maybe offer you Bitcash in Bitcoin Cash in January. Check back with us in January, and oh, by the way, all your orders for those have been canceled. But imagine that in reverse and in exponential orders of magnitude. That's what going to ashes looks like. Okay, so and then here's another question. If you have made tons of money, if you have big gains, even now thinking about, forget the crash, like what will your bank do when they get a massive wire transfer from a crypto brokerage firm? Will they freeze your account? Have you tested that out? Have you talked to them? Do you know if you now look, if you have a couple $1,000s in your that you've made, it's not a big deal. If you have millions, there's a guy that is in our circles, a polo player. I'm sure there are others, who put like $500,000 into cryptocurrencies, right? How does he get that out? You've got to try these things now. I was actually listening to a podcast. It was props to the Crypto 101 podcast, and I think his name is Matthew Aaron. He was interviewing a former Wall Street lawyer by the name of Terrence Yang, and Terrence Yang actually referred to this very idea as that you need to practice selling. And I think part of it was the mechanics. For him, it was more about, just, I look, I don't really necessarily recommend this here because in crypto world, the fees are too high. But, back when I was a financial advisor, I usually tell my clients when they didn't want to sell something because it was down, I would say to them, look, sell it. And then tomorrow, if you can buy it back when you're sane, then go for it, because the transaction costs as a percentage were minuscule. In crypto, that's not so much the case, but practice selling, okay, is a really, really, really important thing for you to be doing. And someday you're going to thank yourself that you did. All right, so that's it. My 3 mistakes again, just to recap: 1, trading, don't do it. 2, HODLing. Yeah, pretty arrogant. Okay, and 3, not testing the escape hatch. So if you would like show notes with links to all of these graphs and various things, sorry, my office is in my barn and they're blowing the aisle right behind me. So you can get the show notes with all of those links at sanecrypto.com /mistakes. sanecrypto.com /mistakes. And remember, you guys, disclaimer, that everything that I've said is for educational purposes only. Nothing should be considered investment advice. You know the drill. Past performance is no guarantee of future results. All investments involve risk, obviously, especially these. It could go to zero tomorrow, so do not, under any circumstances, invest money that you cannot afford to lose. Thanks for listening. I will be back tomorrow with another installment of Sane Crypto Live. Until then, remember, you guys, the way to control fear and greed, which are your biggest enemy, the way to control them is a sane system repeated over and over again as if your life depended on it. I'm Kim Hughes. Go forth and conquer.